Hey guys, today we are going to be talking about technical analysis and risk management. And the TA haters out there will probably like this video because I'm going to validate them in some way. TA doesn't always give you the right thing. It doesn't always tell you the right thing. Sometimes I think it just tells you nonsense. But what it does tell you is how to risk manage. And sometimes that's all you need. You don't need to know when the price is going to reverse. You don't need to know when the top is. You don't need to know when the bottom is. All you need to know is when does your risk outweigh your reward, and when does your reward outweigh your risk. So to highlight this, I'm going to be talking about the Elliott wave theory. I like this example because I don't even believe that it's true, but I do know that it gives you good risk management. And if you had traded the 2017 bubble using the Elliott wave theory, you would have made some damn good trades. Not perfect trades, because the Elliott wave theory, it's not really real. But in my opinion, it's not really real. But it would have given you good selling prices, and that's sometimes all you can really ask for. I mean, not even sometimes. It's realistically all you can ask for. Calling the top, anyone who tells you they called the top when the price is in uncharted territory, at least, is full of shit, in my opinion. So, for those of you not familiar with Elliott wave, here's what it is. It says any legs in the market move in waves of 5, basically. Waves of 5 or 3, but we're going to be talking about 5 in this video. So we'll go up big, down small, up big, down small, up big. And that's 1, 2, 3, 4, 5. So if you had done this way back in the day, these are the earliest days of Ethereum. We're gonna cut out everything. We're gonna cut out the bear legs because we want to only see the present. We want to pretend like we're there. So here we have a leg up. We want to break this into 5 legs. So this could arguably be called consolidation. And consolidation does not count as a leg in the Elliott wave theory. So you could make an argument for starting it here, 1, 2, 3, 4, 5, and that would have given you perfect timing. But for the sake of this argument, I want to give the other side as much leeway as possible so they can't just say, well, you didn't lose this part. This is not a rule. It's invalid. Yeah, fuck you. We're going to use this part just to spite you. So 1, 2, this looks ugly already. I don't want to use it. 3, 4, 5. And then you would have sold in here at 170. Not ideal, because the price got to 420 before crashing back down to 130. So all in all, this is actually a winning trade. Your risk management here is good because you sold after a large price extension. Not bad. You made Ether in the end. You could have bought your Ether for cheaper than you sold it. You made Ether. But I did not sell here. And here's why. And it's because of fundamentals. I'm not in the camp that says TA is everything, fundamentals are lies. Or the camp that says, there's also the camp that says fundamentals are everything, TA is lies. And I think that camp is a lot more prominent. And they're both flawed. You should be using both because, so here's why I wouldn't have sold here, because of fundamentals. When I first bought Ether at $20, humble flex, I decided that the maximum realized value of Ethereum was probably in the tens of trillions of dollars. If Ethereum becomes the global infrastructure of the internet, it's going to be worth trillions. So based on that, the price of 1 Ether will be in the tens of thousands. So based on that, I think that Ether is a good investment as a buy and hold, a good long-term buy and hold investment at anything under $1,000. Okay? It's very important that you fucking have something like this in mind when you're making any investment. So because 1,000 is my number here, do I really want to sell when it's at 170? 170 is like about 1/6 of 1,000. So like, do I really want to give up this 1/6 of my good investment price? Like, I'm paying 1/6 of what I already think is a good investment for. I'm risking that 1/6 for the possible reward of getting something like 1/10 maybe, if I'm lucky. Like 1/10 is my reward. Going from 1/6 to 1/10, not that great. Not really worth the risk, in my opinion. So because of that, I would not have sold here. I would have waited and seen this other leg up and said, okay, now we're at about 350. 350, I have a better reward because I'm selling at 350 rather than 170. And I have a lower risk because since we've extended again, we've extended 1, 2, 3, 4 times now. 3 times we already have, and obviously 3 times was a winning trade in the end, not as winning, but still winning. We have an even higher chance of retracing now that we have 4 waves up. So based on that, I would have, and I did sell in here. This was the first trade I ever made. I bought it back at 150 to 130. I think it was 150. I don't know why I had that number in hindsight. This was, like I said, this was my first trade ever. So I didn't have a good number. If I followed my current process, I would have bought at 180. I would have bought it around here, which is a lot safer. But still, very good trade. Not because, and like I said, the price does not... I don't believe that the Elliott wave theory works fundamentally. Like, just because the market doesn't just always go up, the market doesn't just go up one, down, up one, just because. But I think that if the market goes this high, it's very likely that it's going to go lower than this high at some point, and it did. No matter which top you pick, and this is not a good one to pick, in my opinion, for both fundamental and technical reasons. But even if you had picked this top, you would have been able to buy lower. So here, let's go to a much better example. This is when you're looking to sell, because one, this is the peak of the bubble. This is when you're really looking to sell. So back then, first of all, okay, remember, we don't count consolidation, and this is all consolidation because it has lower highs and higher lows. That makes it a triangle. A triangle is consolidation. Triangle, omega lol, up or down. So here's what we're going to do. We're going to paint a wave on top of this. Up, down, up, down, up. And you would not have seen the top because there was another wave after this. So when we get into this territory, this is where we're looking to sell because we're above 1,000, number one. Even if we weren't above 1,000, we'd still be looking to sell here because we're getting very close. And we have 5 waves. So what would have happened is you would have sold at around 1,200, 1,250. I believe I sold this at 1,250. But what some people would have seen was this last wave up. They say, oh, what? Look, guys, it made a higher high. That means that we're still going up. Wrong. You made 5 waves up into fucking massive bubble territory. This is bubble territory for fundamental reasons too. We don't just trade this off technicals, we trade off fundamentals. At this point, BitConnect, which was like the most obvious Ponzi scheme of all time, was valued at almost $1 billion. Dogecoin, a stale meme from when I was in high school. I'm graduated college at this point. Like, a stale meme cannot be worth $500 million and not be a bubble. It's just common sense. Why would we not sell here? Just because there's another wave up. Do not FOMO here. Obviously, this is all hindsight trading, but it's very obvious if you just don't let the price delude you. And it's very hard. That's something that's easier said than done. It's very hard not to get caught up in this emotionally, especially if you've never experienced it before. I was getting nervous around 700. I made a sell at fucking 800 or something, and then it got to 1,000, and I fucking FOMO'd back in at 1,000. Then I kind of sobered up around 1250, sold this, and then, okay, so another thing that I want to talk about here is when you should exit. There's two strategies for getting out here. You can wait for a rebound. So you sell, you see that the price is going to reverse and you look to exit. You look for a rebound, in which case you would have sold this, which would have put you in good shape. But that usually that's not necessarily going to happen. Let's look at this one instead. So if you waited for the rebound here, you would have missed this. You would have missed this fucking beautiful lower shadow candle. This is why I like to get out early in crypto, is because when it tanks hard and fast, and then it bounces up, and then it just continues to tank. So this lower shadow candle goes from 340 down to 250. If you have buy orders here, you can turn that around and sell it in here within minutes. So I see these lower shadow candles, these long lower shadow candles, and I just think fucking money. Like this, money. All of this is money. I want cash on hand when these happen, because this is like the fastest money you've ever fucking made in your life. You can flip 30% you can flip 30% moves within minutes. That's insane. You'll never see that in any other market, commonly at least. Like, it happens, but not very frequently. So what I like to do is get out early. Otherwise, you can wait for the bounce and sell the bounce, and that's good too. But I like to have cash on hand to sell these lower shadow candles. So because I sold here, I can now flip this. I can buy here and sell in here, and I'll still be out. I'll still be waiting for lower prices. And you can do that within minutes. It's amazing how fast you can make money doing this. So my point of this whole video, basically, is technical analysis doesn't necessarily have to give you predictive power. All it has to give you is risk management. Like, if I do something like a fib retracement too, is this really telling me like the price is going to bounce off here or here because this is a magic level? No, like, it gives me a plan for risk management that I can stick to. And if you had bought here and sold here, or bought here and sold here, like, these are good price points to be catching. You could have sold here, you could have sold here. You want to be buying this, but you got to also factor in the broader context. So this is my worst trade ever. I bought at 500. And this was my last buy. I have not traded at all since buying at 500, mostly because I wanted to fucking go outside and get a life, because I've been doing this for like a year. But this was my last trade, and it was a bad one, because I wanted to fucking take a step away from the screen, and I suffer from FOMO. Like, losing potential ether hurts me so much more than losing potential dollars. So I want to buy at 500 just to be safe. Like, I accepted the price would probably go lower, but it's just not worth the risk for me. And boy, oh boy, did it go lower. Whew, let me tell you, if I had sold at 1200 and bought at fucking 100, I would be in fucking Lubin land right now. I would be, dude, oh my god. I would have Lubin digits of ETH. Not really, but that guy has like 1 million ether. But I would have a lot of fucking ether, and I would be a very, very happy man. I still do have a lot, but I would have a lot more. And, you know, coulda, shoulda, woulda. It's kind of the name of the game, but you get the point. This is where experience comes in. Bubbles, my mentors have taught me now, bubbles don't really just bounce back. They end in desert crossings, which is what we are in right now. The end of a desert crossing. Low volatility, high volume, low price. Very, very obvious. This volume is insane. This is obviously a desert crossing that we're in. You want to buy in here. This is where the smart money buys. All this volume is smart money buying and dumb money selling. So, when this bubble comes back around, and I believe that it will, I'm not going to make that mistake again, believe me. So I hope you guys learned something. Risk management is more important than saying, I know where the price is going to go, because, well, one, you don't know where the price is going to go. And two, I don't really know where I was going with that, but two, your risk management is the most important part. Just that's all you need to take away from this. Risk fucking management. All right, later.